Welcome back to Orange US Stock Research. Today, we are taking a comprehensive deep dive into SanDisk Corporation, trading under the ticker symbol SNDK. Right off the bat, let me give you our final verdict. We assign SanDisk an overall score of 82 out of 100, making it a compelling buy in the current macroeconomic environment, despite its massive recent run-up. Since its historic spin-off from Western Digital in February 2025, this stock has been an absolute rocket ship, soaring over 2,500%. But the critical question remains, is the current valuation of $920 per share justified, or are we staring at the peak of a massive NAND memory supercycle? In this video, we will break down their business fundamentals as a newly independent pure-play flash memory powerhouse, take a closer look at their balance sheet, run through a detailed scenario analysis for future price targets, and finally, present our comprehensive 5-dimension scorecard. If you want to know whether you should hold, fold, or buy into this AI storage titan, stick around until the end. Let us get started. To understand the current SanDisk investment thesis, we must first look at its recent structural transformation. In February 2025, Western Digital completed a tax-free spin-off of its NAND flash memory division, relisting it as an independent, standalone entity, SanDisk Corporation. This strategic separation unlocked massive shareholder value by creating two highly focused companies. Western Digital remained a pure-play hard disk drive manufacturer, while SanDisk emerged as a pure-play flash memory powerhouse. As an independent company, SanDisk now has the strategic flexibility to aggressively pursue high-margin growth opportunities in the rapidly expanding solid-state drive and enterprise storage markets. Their business model spans the entire spectrum of flash storage, from ubiquitous consumer SD cards and USB drives to massive, high-performance enterprise solid-state drives designed specifically for artificial intelligence data centers. By controlling the underlying NAND technology and the final consumer product, SanDisk captures margin at every step of the value chain. The primary catalyst driving SanDisk's explosive stock performance is the artificial intelligence data center build-out. While much of the market's attention has been focused on graphics processing units and compute power, the unsung hero of the AI revolution is data storage. Large language models require absolutely massive datasets for training, and more importantly, they require lightning-fast data retrieval for real-time inference. Traditional hard disk drives simply cannot keep up with the data throughput required by modern AI accelerators. This has triggered a massive upgrade cycle, forcing hyperscalers and cloud service providers to aggressively transition to high-capacity, high-performance enterprise solid-state drives. SanDisk is perfectly positioned at the epicenter of this storage supercycle. As one of the few global manufacturers capable of producing cutting-edge, high-layer count 3D NAND flash memory at scale, they are experiencing unprecedented demand. This structural shift in data center architecture provides a multi-year tailwind for SanDisk's highest-margin enterprise product lines. While the enterprise data center segment provides explosive growth, SanDisk's consumer portfolio remains a critical cash cow and a massive competitive moat. The SanDisk brand is virtually synonymous with portable storage. They maintain dominant market share in the photography and videography sectors with their Extreme Pro line of SD and micro SD cards. Furthermore, their portable solid-state drive lineup has become the industry standard for content creators who require rugged, high-speed storage on the go. This consumer dominance provides two distinct advantages. First, it generates steady, reliable cash flow that helps smooth out the inherent cyclicality of the semiconductor memory market. Second, it allows SanDisk to achieve massive economies of scale in their NAND fabrication facilities, lowering the blended cost per bit across their entire product portfolio. This dual-pronged approach, dominating both the high-margin enterprise sector and the high-volume consumer market, is the foundation of their competitive advantage. Moving to the financials, let us dive deeper into the income statement. Looking at the trailing 12 months as of early 2026, SanDisk generated $8.9 billion in revenue. This represents a robust 23.6% year-over-year growth, signaling a powerful recovery from the recent cyclical downturn in the NAND memory market. Gross profit came in at $3.1 billion. However, it is crucial to note that the company is currently reporting a GAAP operating loss of $622 million for the trailing 12 months. Before you panic, this requires context. This loss is entirely driven by massive other operating expenses, totaling nearly $1.9 billion, which are primarily one-time restructuring and separation charges related to the spin-off from Western Digital. If we normalize for these extraordinary items, the underlying core business is highly profitable and accelerating rapidly. What truly highlights the strength of SanDisk's recovery is their rapidly expanding margin profile. The semiconductor memory market is notoriously cyclical, and during the trough of the cycle in fiscal year 2023, SanDisk's gross margins collapsed to a painful 7%. However, thanks to disciplined supply management across the industry and surging demand from AI data centers, pricing power has returned. For the trailing 12 months, gross margins have rocketed back to an impressive 34.8%. This dramatic margin expansion is the primary driver behind the stock's incredible run. As NAND spot prices continue to firm up and the company shifts its product mix toward higher-margin enterprise solid-state drives, we expect this gross margin expansion to continue. While GAAP net income margins remain temporarily negative due to spin-off costs, the trajectory of their gross profitability clearly indicates a business entering the sweet spot of a powerful upcycle. Our analysis is never complete without scrutinizing the balance sheet. Following the spin-off, SanDisk's capital structure underwent significant restructuring. The company currently holds roughly $1.54 billion in cash and equivalents against total current liabilities of $1.65 billion. What is particularly impressive is their aggressive deleveraging. Total debt has been rapidly reduced from $1.85 billion in fiscal 2025 down to just $603 million in the trailing 12 months. Consequently, SanDisk's net cash position has turned positive and continues to grow, providing immense financial flexibility. Total assets stand at $13 billion, while shareholders' equity is $10.2 billion, translating to a tangible book value of roughly $35 per share. This pristine, cash-rich balance sheet provides management with immense optionality to invest in next-generation NAND fabrication technology or return capital to shareholders. On the cash flow side, SanDisk's performance is nothing short of spectacular, and this is where the true health of the business shines through the noise of GAAP accounting. While the income statement shows a net loss due to spin-off charges, the cash flow statement tells a completely different story. Operating cash flow for the trailing 12 months swung from a negative $713 million in 2023 to a massive positive $1.63 billion. Because capital expenditures have been tightly controlled at $134 million, free cash flow reached an exceptional $1.49 billion. This represents a free cash flow margin of nearly 17%. This immense cash generation proves that the core operations are highly lucrative. It is this geyser of free cash flow that has allowed SanDisk to aggressively pay down over $1.3 billion in debt over the past year. Now we must address the valuation, which is the most debated aspect of the SanDisk investment thesis. At a current share price of roughly $920, SanDisk commands a market capitalization of approximately $135 billion. With trailing 12-month revenue of $8.9 billion, the stock is trading at a price-to-sales multiple of roughly 15 times. For a hardware manufacturing company, a 15 times sales multiple is extraordinarily high, pricing in years of flawless execution and sustained hypergrowth. The market is clearly treating SanDisk not as a cyclical memory manufacturer, but as a secular AI infrastructure play, akin to NVIDIA or Broadcom. While the trailing price-to-free cash flow multiple sits around 90 times, forward estimates suggest this will compress rapidly as spin-off charges roll off, and NAND pricing strength flows directly to the bottom line. However, at these levels, the margin of safety is undeniably thin. Despite the stretched valuation, Wall Street remains overwhelmingly bullish on the SanDisk story. Recently, analysts at Bank of America Securities and other institutions have maintained their buy ratings and raised their price targets to the $900 range. These upgrades are driven by proprietary channel checks indicating sustained strength in enterprise NAND pricing and robust demand from hyperscale cloud providers. Furthermore, with the stock price approaching $1,000 per share, there is rampant speculation across financial media regarding a potential stock split. While a stock split does not alter the fundamental underlying value of the company, it often acts as a powerful psychological catalyst, increasing retail investor participation and driving short-term momentum. The combination of strong institutional backing, a clear AI narrative, and potential corporate actions continues to fuel the incredible upward trajectory of the stock. Now let us run through our scenario analysis for SanDisk, projecting where the stock could trade by the end of fiscal year 2027. In our bear case, we assume NAND pricing enters a downturn as supply catches up with demand. Enterprise SSD growth decelerates to single digits, and gross margins compress back toward 25%. Under these assumptions, applying a 10 times forward price-to-sales multiple, we arrive at a bear case target of approximately $650 per share. In our base case, we assume continued healthy demand from AI data centers, stable NAND pricing, and gross margins expanding to 38%. Revenue grows at approximately 20% year-over-year. Applying a 13 times forward price-to-sales multiple, our base case target is approximately $1,080. In our bull case, we assume an acceleration in AI infrastructure spending, NAND supply tightness driving pricing power, and gross margins reaching 42%. Revenue growth accelerates to 30% plus. Applying a 16 times forward price-to-sales multiple, our bull case target reaches approximately $1,350 per share. Looking at the broader picture, several powerful catalysts could drive SanDisk's growth trajectory even higher. First, the global AI infrastructure build-out is still in its early innings. As large language models grow exponentially in size, the demand for high-capacity, high-speed enterprise SSDs will only intensify. Second, the ongoing transition from hard disk drives to solid-state drives in traditional data centers represents a massive multi-year replacement cycle. Third, SanDisk's investment in next-generation technologies like UltraQLC NAND and PCIe Gen 5 interfaces positions them at the cutting edge of storage innovation. However, investors must also weigh significant risks. The NAND memory market is inherently cyclical, and a supply glut could rapidly erode pricing power and margins. Customer concentration among a handful of hyperscalers creates revenue vulnerability. Additionally, intense competition from Samsung, SK Hynix, and Micron means SanDisk must continuously innovate to maintain its market position. The balance of these catalysts and risks shapes our overall investment thesis. Let us now present our comprehensive 5-dimension scorecard for SanDisk Corporation. For business fundamentals and competitive moat, we assign a score of 9 out of 10. SanDisk's vertically integrated NAND manufacturing, iconic consumer brand, and diversified product portfolio create a formidable competitive position. For financial health, we give 8.5 out of 10. The company has aggressively deleveraged, achieving a net cash positive position with exceptional free cash flow generation. For growth potential, we assign 8.5 out of 10. The AI storage supercycle provides a powerful multi-year tailwind, though cyclical risks temper our enthusiasm slightly. For risk profile, we give 7.5 out of 10. While the business fundamentals are strong, NAND cyclicality and customer concentration introduce meaningful uncertainty. For valuation, we assign 7.5 out of 10. At 15 times trailing sales, the stock is priced for perfection, leaving limited margin of safety. Summing these scores, 9 plus 8.5 plus 8.5 plus 7.5 plus 7.5 equals 41. Multiplied by 2, our total score is 82 out of 100, resulting in a buy rating. Before we wrap up, please note this important disclaimer. This video represents the personal opinions and analysis of Orange US Stock Research and is intended solely for informational and educational purposes. It does not constitute investment advice, a recommendation, or a solicitation to buy or sell any securities. All investments involve risk, including the potential loss of principal. Past performance is not indicative of future results. Always conduct your own due diligence and consult with a qualified financial advisor before making any investment decisions. Thank you for watching, and if you found this analysis valuable, please like, subscribe, and hit the notification bell so you never miss our next deep dive. See you in the next video.